Hello and welcome to Battle 22. This week we're going to reveal who won last week's battle between Berkshire Hathaway and AIG. We're going to see how our portfolios have done over the last 7 days, and we're going to battle two companies with spotless management records against each other. Without further delay, let's get underway. Last week, Berkshire and AIG battled it out, and it was no contest really. With 3 votes to none, the winner last week was Berkshire Hathaway.
3, 2, 1, go.
Every week, we invest £25 into each portfolio. One portfolio where you select the stocks, one that tracks the market, and one that generates income to pay to you. We'll then invest an extra £1 into each portfolio for every 100 subscribers we get. Last week was pretty kind to us, with the income generator being the surprise leader at 3.5% increase, the benchmark beating the Battle Royale, coming in last with 2.9%. And this week, red all around. The income generator, the worst of the lot, 0.7%, but Battle Royale performing worse than the benchmark, 0.5 to 0.3 in the negative. Here were the biggest movers in our portfolio, and excitingly, one of the very new recent arrivals, Dick's Sporting Goods, was up almost 10%. Unbelievable. Games Workshop going from strength to strength this year, up another 7%. And it's just incredible what it's doing. Adidas, a surprise entry onto this. I wouldn't have thought that it was doing so well, but very happy that it is. And Tesla falling back from massive highs, nothing to worry about there. But the big concern is Renew. Our nuclear stock has just fallen off a cliff following some weak earnings results. Looking at the Battle Royale in slightly more detail, you can see we underperformed the UK market as well last week. However, if we take a look at the total value and see how the holdings are doing within the portfolio, you can see Tesla still number one. On the beach, not that far behind. Nickel's doing as well as it can, and scrolling right down to the bottom, Renew not managing to take the last spot despite its massive fall of 23 points or percent rather last week. B&M, the UK retailer, holding the honour of having the last spot. Money Supermarket vying for contention, our REIT as well, and Tate and Lyle too. YouGov's the other big name that you might recognise. And the last one I'd just like to mention quickly is Black Rifle Coffee, which had been doing really well but is now down almost 10% for us. We're now up to 20 holdings, and that disastrous performance last week leaves us with 9 in the green but 11 in the red. We are losing more than we're winning. I need to do better. And that brings us on to what we're getting paid from the income generator. We're now up to £14.99 a year. Last week that was £14.27. We've got our December payment locked in at £2.43, and the March payment is now up to £2.67. So that means we're going to pay out to a lucky subscriber £5.10 at the moment, but that's going to go up. And so, how does it look overall? Well, we've now added £500, and as of last week, there were some lovely, healthy green figures there. This week, still in the green, but not looking quite as good. You'll see the Battle Royale's taken a hit, 11.25% up, down to 8.92% up. Still beating the benchmark, though, which is up overall 5.9% this week. So we're going to keep going.
3, 2, 1, fight.
This week we're looking at stocks with spotless management records. Simply Wall Street thinks these companies are very well run and have very healthy financial records. Let's take a look. We have a company that everyone in the UK knows and loves. It's Greggs. They sell us our sausage rolls, and they sell a lot of coffee as well. One of the reasons I'm excited this stock is appearing this week is that their share price has just fallen off a cliff. On Friday it dropped, I think it was about 25%. Was it that high? I don't know. But anyway, it was a massive drop of some weaker forecasts and bad earnings. But it wasn't that bad, and I think it might be a bit of an overreaction. It's still a fantastic company. Its PE ratio is now 15.6 times. And for a growth company that I think is still growing, that's not bad at all. I know it's slightly depressed in the UK. Anything under 20 isn't that big a surprise, but it's a great company, and got very strong financial health. It even pays a dividend of 3.1%, so quite a healthy dividend. And the future growth is pretty solid according to some of the analysts' expectations. So its competitors are going to have to be a good one to compete. And in fact it is. It's 3i Group. I've been following them for quite a while, actually, independently, and it's a bit of a difficult company to describe, a little bit like Berkshire Hathaway from last week, where it invests in other companies. It's a bit of a VC company, but it does own certain companies outright, one of which, its biggest one, is called Action, which is a low-cost retailer which is taking over Europe. So it's one to keep an eye on, and you need to get your head around it to try and understand what's going on. But this is also an incredible company. It's done quite well for me in my other portfolio, and according to Simply Wall Street, it's trading at 55.8% below their estimate of fair value, which is a massive amount. Its share price has just continued to go up. There's no big drops over there. Its PE ratio is 8.8 times, so it does seem like this could be a bit of a bargain as well. This is what Simply Wall Street thinks the difference between its current price and its value is. Future growth also looks pretty solid, again according to the analysts, whether you believe them or not. It's got a relatively strong past performance and financial health. It does also pay a dividend, only 1.7%. I say only, that's still great. Just doesn't really compete with Greggs, but it is a very good company in and of itself. If we look at the two back to back, both got lovely green snowflakes. 3i Group slightly greener, I would say, than Greggs, but both very good, nothing to sneeze at. 3i Group 55.8% below their estimate of fair value, Greggs 24%, but I think that is it's a unique opportunity for Greggs because it's just due to that dip, and it's I expect it to pick up and to keep growing at a steady rate. Is it safer than 3i Group? Well, that's debatable. 3i Group is a bit more diversified, but Greggs has this long-term strategy of growth, and there's a clear route to growth. So it could go either way.
Okay, let's take a look at and compare their high-level metrics.
Greggs is the smaller of the two companies, with a market cap of 2.14 billion compared to 3i's 36.96 billion. Looking at the other stats though, there seems to be a bit of distance, at least in my mind, between these two companies. 3i Group has a revenue of 3.98, whereas Greggs is only 1.81 billion. And the prices, if you look at the PE ratio, Greggs is more expensive, but its earnings per share, its EPS, is lower, and the dividend is higher, yes, 2.8%. However, 3i Group's got a handy 1.7% as well, and is less volatile with a beta of 1.02. So still close, both good companies, but for me 3i is just pulling ahead slightly here.
So there we have it. I'd love to hear who you think should win. Please drop your thoughts in the comments. Otherwise, my suggestion for this week, and I think we should invest in, is... Thank you so much for watching, everybody. I hope this week is better in the markets for you than last week was, and I look forward to seeing you the same time next week. Have a good one. Bye.
Goodbye.